That's the last item we look at today. We look at division performance. As far as division performance is concerned, in our exams, there are 3 items that we need. The concept of responsibility accounting, as illustrated in this past exam question. September, December 2017, question number 32. And also in the same, there's the concept of ROI and also RI. So let's cover this together. What is the concept of responsibility accounting all about? Responsibility accounting, what is it all about? Well, this is a terminology that scares many students. Many students get scared with this terminology of responsibility accounting. But when we simplify it, they all say, oh, we know about that. What do we mean? If I use this expression, cost centers, revenue centers, profit centers, investment centers. If I ask you a question, do you know these? Please use the feature. Use a feature, where you put your hand, you raise your hand. There's a feature here where you raise your hand. Please use that feature. Use that feature to raise your hand. Can you all just use that feature of raising your hand to tell me if you know about this issue of cost center, revenue center, profit center, and investment center? Tell me if you know about this. Only Mr. Chavala has put the hand up there. What of the others? You know how to use a feature? Yes, where it says more there. Go and just raise your hand, okay? There's a second participant also has raised their hand. Who else? Others have not raised their hands. There is only Chavala, Rita. Others have not raised their hands. Why? Yeah, so responsibility accounting involves splitting organization into smaller units called responsibility centers. So this is a performance management framework. Performance management framework where we split our organization into smaller units called responsibility centers. And these responsibility centers, we can choose to run them as one, as cost centers, as revenue centers, as profit centers, or as investment centers. For the purpose of measuring and managing performance. When we come to measuring and managing performance, use accounting variables or accounting results. So responsibility accounting is a performance management framework. And this framework is normally introduced when you have divisionalized our organization. When we divisionalize. So when you, as an organization grows big, For effective performance, what do? We split it up into divisions. And all we are saying is that these divisions, we can run them as any of these. We can run them as cost center, revenue center, profit center, or investment center. These will be assigned to responsibility holders or managers. And at the end of the season, at the end of the month, we're going to evaluate the performance of both the manager and the division. So there's a performance, there are two issues. The performance of the manager themselves and also the performance of the division. The manager and the division itself. And the concept is that we must measure, we must just focus on controllable variables. We must focus on controllable variables when we measure the performance of responsibility center holders. Don't bring in things over which you have no control. In a cost center system, the manager only has a control over cost. He just spends, he's running a spending unit. So at the end of the day, for control purposes, we're going to compare the costs and the budgets or the standards. Revenue, these are sales outlets. This is where in our responsibility accounting framework, our responsibility center simply represents sales outlets. So these are simply sales outlets. In a profit center, we are looking at a situation where the managers have got responsibility over sales and costs. The managers have got responsibility over sales and costs. The managers have responsibility over sales and costs. So a particular manager is expected to generate some revenue, and in the process, you incur expenses. So at the end of the day, we'll be talking about profit. How much profit has he made? And calculating this profit, we don't want to include any uncontrollable items. Then you've got an investment center. In an investment center, the manager is answerable for a number of things. They've got the sale, he's got the costs, and also he's got assets. He's got the authority to invest. He has got a say in the procurement of assets. So the manager is responsible for the sales, for the cost, which gives him profit, and also how much he invests in the division. Now, in an investment center, how do we measure performance? Use your return on investment and the residual income. In an investment center, how do you measure performance? Return on investment and residual income. Now let's be practical here. Let's be practical. I have a question for you. Let's be practical here. I have a question for you. Please, we are going to try that question. Want to be practical? It's a revision. We need to try some questions so that you are aware of what we're on. So We've just discussed that in responsibility accounting, where we are running investment centers, the major KPI that we use, is ROI. So we want you to calculate the ROI here. Please, can you calculate your ROI? And you're going to post. Calculate your ROI and you're going to post. Okay? So I'll pause the recording. I'd forgotten to record that bit. So let's just record that the answer is 27.59. Let's go. The next one. Here we are. The other KPI that we use for investment centers, if you've got an investment center, if you've got an investment center, the other KPI that you are going to use for this is residual income. Residual income. So we want you to calculate residual income here. So we've got that question there. If residual income is used as a basis for investment decision, which divisions would choose to invest in the major disadvantage of ROI? What's the major problem of ROI? Which the examiners have asked again and again. It discourages investment into new assets. Let us now see what happens if we use ROI. So let's go. Can you please calculate the ROI? Let's calculate the ROI for division A and division B. Let's calculate the RI divisions. So the residual income is the profit. How do you get the profit? Operating profit margin multiplied by the sales. Operating profit margin multiplied by the sales. Okay. Notional interest, that multiplied by the capital employed. That multiplied by the capital employed. So again, we want to encourage you to go through questions from time to time so that you're able to pick these. Any questions? Any questions? So this is how we calculate our residual income, profit lesser notional interest. And normally, where the ROI says don't go ahead with the investment, we always find that ROI is more likely to say go ahead. So normally, in PM questions, is when there's a proposed investment. So when there's proposed investment, normally the issue of ROI and ROI would arise to see what indications or signals will be given by the two. Okay. Good, so that was our question there. Why have they put in the percentage of the current return on investment of the division? No, you don't need it. You didn't need it. You didn't need it. Yeah, it was just to distract you. So just to distract you. Somebody says, but why did they give us the current ROI? It was just to distract you. That's all. That's a distraction. Okay, fine. So let's move on to the last item. The last item is transfer pricing. The last item is transfer pricing. So what is transfer pricing? What is transfer pricing? How does transfer pricing arise? Let's talk about transfer pricing. So how does the concept of transfer pricing arise? When you divisionalize, when you have created a division and you have a situation where responsibility center A does work for responsibility center B. In other words, they sell a component. Normally talk about a component. A sells a component to B. A transfers a component to B. At what price should this be transferred? Should it be at zero price because these belong to the same organization? Should it be at zero price? The answer is if you use zero price, you're going to the whole idea behind the accounting. You say A should transfer for free at no charge. You're going to have one challenge. The challenge you're going to have is that you are going to defeat the whole idea behind responsibility accounting. Responsibility accounting is a mechanism which is there to improve performance. Now, if they are going to transfer at zero, how are we going to appraise their performance? Their performance will be understated. That will be the effect. You understate this performance. This performance will be overstated. So we need to figure out a system of transfer pricing. So a system of transfer pricing will support responsibility accounting. It will lead to motivation, fair performance appraisal, and better performance by the whole organization. So that's what happens when you introduce a system of fair transfer pricing. What are the 4 features of a good transfer price? Please, can you all indicate to me the 4 features of a good transfer price? Can you type in the chat? What are the 4 features of a good transfer price? What are the 4 features of a good transfer price? Let's type in the 4 features of a good transfer price. How should a good transfer price between A and B look like? Features of a good transfer price. What do you expect from a good transfer price? What do you expect in a good transfer price? Please, you type in the chat. Type in the chat. I know you know them. Once I start, we are all going to participate. Fair performance appraisal. Everybody involved must be happy with their performance. Number 2, It must respect autonomy. Number 3, it must support goal congruence. It must support goal congruence, or what we want a situation where there is overall corporate profit maximization. And lastly, we want to make sure that we are able, within the framework of the law, to minimize our tax liability. So these are the core. These are the core. So if a question says, please tell us so, before you can now mention others such as fairness and transparency, but these are the core ones. These are the core items. Fair performance appraisal, everybody involved. A must be happy that yes, the transfer price is leaving me, is leaving my performance fairly appraised. B must also say, yes, the transfer price is leaving my performance fairly appraised. Okay. Autonomy. These must not be forced to apply the transfer price. No, you must be allowed to negotiate. They should even be allowed to say, look, if you don't want to sell internally, go and sell outside. If you don't want to buy from within, go and buy from outside. Such kind of allowance must be there. Whatever happens at the end of the day is the welfare of the whole organization. Whole organization. The whole organization, we must make sure that the overall profit is maximized. So we must look at the interest of the whole organization. So a good transfer price is the one which leads to maximum profit for the whole organization. And if you're a multinational organization where you're operating between different countries, across countries, you also want to make sure that you don't necessarily suffer a very high tax because of the transfer price that you're using. Is that okay? How do you design a transfer price? How do you design a transfer price? What methods are there to estimate a transfer price? What are the two methods that we have? We can use a market-based approach, where the component has got an external market, the base is used the external market. If there's no external market, we look at how much has been spent. Cost-based approach. So you can either use external market-based approach or cost-based approach. Okay. So we've got some questions for you to try out. We've got some questions for you to try out on this particular one. Where are the questions? There's this question here. I would want you to tackle this question. You need to fill in here. Then I'm going to post another question on the forum. I'm going to post another question in the forum, which you can do before tomorrow's session. Yeah. Now let's just agree on one item for tomorrow. Let's agree on one item for tomorrow. Okay. So tomorrow's session, I'll post on the forum, will not start at 9 hours, no. Tomorrow's session is going to start at 11 hours, 2 hours later. So we're going to start 2 hours later. Eh? How we're going to cover up the 2 hours, we'll discuss tomorrow on how I'm going to give you back your 2 hours. This is here, that cannot allow us to walk out with the time. So tomorrow we'll discuss how we can deal with the 2 hours. One of the proposals, of course, instead of ending at 16 for tomorrow, we'll end at 17 hours. So that is one way already of dealing with our time. So tomorrow we end at 17 hours, we would have recovered one of the hours. The other hour, I'll discuss with you how I give it back to you. But the transfer pricing question, this one and the one I'll give you, please do them so that tomorrow we can go through the solution together. Is that okay as we end? Is the announcement clear for tomorrow that will start at 11 hours? Is the announcement clear to everybody? We need to agree. Okay, fine, that's okay. So tomorrow, please, let's log in. I'm also going to post on the forum. And those who are not here today will tell Mr. Chongo that they must be added to the forum. All right, thank you very much. At least you have persevered right to the end. Others have walked away on the way. It does happen. And those of you who have been here through and through, I'll see what additional support I can give you too. Those who have been around, I mean, how many of you have been around? Yeah, those who have been around. Mr. Chavala, there's Henry there, there's Jackson Banda, there's the Mapalo Chris, there's Collins. Yeah, so we'll see what we can do to give you further support. Yeah. All right, we'll see you tomorrow. Remember, tomorrow is starting at 11 hours. We're going to recover the lost time by extending. Okay.